Economist at Credit Suisse. She joins us on the phone line, and we've got Vivek, Rajpal, the rate strategist at Nomura, India, also with us. Deepali, hi, good morning. Let me start with you. For the first time in the 5 meetings, of the MPC, we had one dissenting member, and that too advocating for a 50 basis points rate cut. What's your sense? Do you think in the upcoming, policy, we are likely to see a rate cut?
Hi, morning. So actually, like you pointed out, most of the concerns raised by the MPC in the last few meetings have actually been addressed to a great extent in the last couple of months. Lower inflation for the last month and even the next month, which is due, I think will be lower than what you've seen so far, which means significant undershooting of 4% and the numbers being very close to the lower end of RBI's range itself. I think earlier in the last couple of policies, there were also concerns around capital outflows that have also moderated to a great extent. I mean, we've been seeing around 4 billion FII inflows in debt for the last few months, and INR has been relatively stronger over the last few months as well. So I think those concerns have been alleviated as well. And the recent most change after the Fed policy has clearly been the sharp moderation in oil prices, and we estimated that this could mean that further reduction in CPI inflation by about 25 basis points. So we switched to a rate cut of 25 basis in the August policy earlier this month, and we think that it's pretty likely that there is going to be one in the August policy review.
Hi Deepali, good morning. There were already people factoring in a rate cut after we saw the last inflation number, which came at 2.18%. A lot of people like you are now redrawing their inflation expectations to below 2% for the months of June and July. That was discounted in the bond market. I just want to know if you read anything in the minutes that would make the market more convinced of the rate cut.
Right. So I think the market was pricing in a 25 basis point rate cut before the minutes came out. So I don't think the market is really reading into anything more than that, because one of the factors which we still have, so right now we have a 25 basis point cut, and we are also highlighting a risk of a 50 basis cumulative, not immediately, but cumulative. But I think the big question mark will still remain around GST implementation. Broadly, the market is looking at GST to be disinflationary. But we are still of the view that on implementation, you will see an impact which will be inflationary. It will be manageable to the extent that it should add only about 20 to 30 basis points. But to the extent your compliance cost goes up, input credits do not filter in seamlessly, we do expect it to be inflationary. So I think the central bank will leave room for that impact to play out. The other second upside risk, the major one which they've been highlighting, is really the central pay commission and the housing allowance, and you still don't have a decision on it. So if that comes in, there will be an impact. It will be lower than expected because the state governments, majority of them, have not factored the housing, the pay commission for this year. But I think these two risks will probably mean that a market will not factor in a bigger rate cut at this point in time.
Okay, so CPC and GST remain risk for future rate cuts. What about the fact that we've seen a lot of loan waivers from states? That can also reverse and stall the kind of improvement that we've seen in the fiscal deficit. Would that be a concern for the Reserve Bank of India?
Especially because all the members are alluding to it.
Yeah, that's right. So we've seen a couple of states implementing the loan waivers already. I mean, and generally seen as a risk to inflation in the next in say the next 6 months or so. And we have our own trajectory. I mean, even after not including say a pay commission and farm wave lowers, we do see inflation edging up higher to about 4.7% by end year. So it's going to be pretty difficult for them to come out with a very dovish stance unless your inflation scenario is like exceptionally fantastic. So if GST is deflationary, there is no pay commission, housing allowance whatsoever, and food inflation continues to moderate. So you need these preconditions for further space for easing later during the financial year. But loan waivers per se clearly add to the inflation risk.
Okay, so one cut is what you can be more confident on, is what you're saying.
That's right, that's right.
Okay. Well, we also have Vivek Rajpal, the rate strategist at Nomura India, joining us. Vivek, after you read the comments, today will you go out and buy Indian bonds?
Yes, so I think as far as MPC minutes were concerned, they were incrementally more dovish related to what RBI has been communicating. However, there was no significantly extra information. What came clearly as an incrementally dovish relative to previous stance was that many of the hawkish members who were citing upside risk to the inflation turned neutral and are saying that one should take wait-and-see approach, whereas those who were dovish are now calling for a 50 basis point of a cut. I mean, there's only one member. So I think the broad direction in which market is going, which is lower yields, is something which is expected to continue. And I would think the probability of rate cut related to what it was before MPC minutes has actually increased.
Okay. Vivek, good morning. So, has the market priced in, say, 1 or 2 rate cuts already, or do you think it will price that in as we move forward? And how much lower can the yields go from here?
Right. So I think there are two aspects. One thing is that I think one rate cut is probably in the price. I can say 80% probability of one rate cut is in the price. But more importantly, even I think we have moved away from the fact that we were talking about next step as a hike in 2018, etc., etc. That fear of market seems to have gone down. I mean, what I think the way market will trade is, even if we get one rate cut, RBI will continue to remain dovish, and market will continue to discuss if there is another probability of a rate cut after this. So, for market, what is more important is that the inflation premiums which bond yields were commanding for the future inflation trajectory seems to have come down. And from that perspective, even if market get only one cut, there is no strong case for the spread widening between, say, 10-year bond yield and the repo rate.
Let me get the number right. Let me get the number right. At the moment, it is 6.43. After this minutes, do you see it going to 6.4? And if there were a cut in July, I mean, we will have benign inflation numbers between now and August 2nd. If the August 2nd cut comes, what is the low you are expecting in yields? What is the number we should look at?
All right. So, as I spoke in our last conversation, 640s was the yield level which I was expecting to break like relatively soon. And I think within today or maybe this week we will break 6.4. I think 625 is a reasonable expectation going into the August monetary policy meeting as far as the 10-year bond yield is concerned.
Okay. Well, there's just one more point I wanted to ask Deepali. Now I'm not able to get that phrase correctly, but Viralacharya seems to indicate that selective softening of credit is what he would like. For instance, RBI gave only for housing loans a lower risk weight, and all housing finance companies cut rates. So he seems to be looking for selective rate cuts for some sectors. If I remember right, the word construction came in. You expect more of that, Deepali?
Yeah, I mean, even if you look at the way this NPA restructuring is happening, it does seem like they're going to be pretty selective. So, like going after just the large accounts. going after just, like you mentioned, some sectors where they can enable rate cuts. And broadly, I think he's also been referring to a broader accommodation, which could also mean that, leaving enough liquidity with the banks for them to be able to decide where they want to park that liquidity and where they want to lend. So another point which I think is important there from a rate cut point of view is that if they're able to work around this broader accommodation framework, then your need for rate cuts, should eventually go down.
Okay, so your low would be 6.4, like Vivek, or would you say it can go below 6.4?
We are actually cautious in the near term on bonds because, like I mentioned, foreign investors have been big buyers, and buying could slow in the near term with around 90% of available limits being used up. And also from a last week FOMC perspective, we think that appears to have drawn a line under USD weakness for now. So both these factors could mean that you should be probably a little bit cautious near term, but we are constructive over the medium term, especially the 2019-2022 bonds.
All right. Thank you very much, Deepali Bhargava and Vivek Rajpal, for joining us.